Good morning. Oh my goodness, there is so much to talk about. Megan pulled up her slide deck and was re-reviewing the real estate numbers, and her first words were, I think they were, wow. I think maybe some other explanation that we're not going to repeat. And I know that Powell came out yesterday and he did exactly what we expected him to do. And then he took a left turn. So we're going to talk about that. We're going to talk about the 10-year. We're going to talk about interest rates. We're going to talk about the economy, mostly the Fed. And we're going to talk about the brakes that just got slammed on the real estate market. Mm-hmm. You guys are feeling it. We're not telling you anything that you don't already know. What we're going to try and talk about is what is the data and the facts that can help you support your clients in a time of change when in reality, they're not going through nearly as much change as you are. I had this conversation with a number of different groups yesterday, and it really is settling in on me that we are feeling this shift so personally because we are so dependent on interest rates, right? A lot of the market isn't. There's a lot of people that have very steady jobs. In fact, I'm going to show you some of the job numbers. And if you were a job stayer, you got a 7.7% increase in your wages. And if you were a job leaver, job hopper, you got an over 15% job increase.
Oh, wow.
Yeah. So to say that the whole world is a mess right now, well, let's just focus on the United States because the world is a mess. But to say that the United States is in a shift, we are feeling the shift first. So that's where I came up with my quote this morning, because talking about all this big news that is absolutely impacting us deeply, we have to be calm because our clients aren't feeling it. One of the conversations I had with my team yesterday, I was like, stop talking and listen more. We have a lot of information to share, but it might not be their world that they're living in right now. And just helping them make the best decision when it comes to real estate is so critical over these next 6 months. So here's my quote. Peace is always right here. You just have to create space for it. Right? So listen more, create a space for the peace of finding the solutions, give your clients the opportunity to let you know where they're at. And maybe the stress that you're feeling isn't the stress that they're feeling, because I'm going to show you some economic news that's going to blow your mind. Like the economy is still strong and it's still holding on, regardless of what Powell and the Fed are doing, even though that's very personal to us.
Definitely. Yes. Well, I pulled up the numbers just to take a quick peek at what happened this last week. And the sellers that are in the market to sell are very serious about selling. And they're really in it and they're sticking through. And we're still waiting for this big purge of expired and withdrawn transactions to help drive down our inventory that usually catapults our market in the spring months when inventory dips and our buyer pool starts to look again. And I'm getting a lot of questions about what do you think is going to happen next year? And so I think we're going to go over some of those numbers as to what I think is going to happen next year, but it's going to be a different start to 2023 than what we've experienced for the last 3 years in a row. And so we've got to be prepared and armed for that. And trying to time the market is going to be really challenging next year because it's all going to be very dependent on what happens with interest rates and who knows what's going to happen with that, because the reports that are coming out are very varied about what their opinions are about when interest rates might fall or if they're going to fall in 2023 and when the best time is to be a buyer in this market. And so I still am firmly a believer that now is the best time to be a buyer in the market. You have the most amount of choices available per buyer available right now. And I think that if you're in the market, now's a great time because you have a lot of negotiating power and you also have a lot of creative lending solutions that are out there to help try to buy down that rate. And so I think it's important that if you're looking right now, that now it's probably your best time to buy a house, because when rates come down, we're going to see this catalyst happen in the market again, where people are going to refinance and they're going to start purchasing again. And again, the numbers are on our side in terms of the age of our population and buyers that are getting into purchasing their first home. Wave of millennials coming in as our first time home buyer. And so I still think that now's the best time to buy, but let's go ahead and take a look at some of the numbers. And it's interesting to see what's been happening over the last couple of weeks, because we know that the market has slowed down significantly. And so it's important to keep this information in your back pocket so you can better arm your buyers and sellers as to what's happening in our marketplace. But it's really interesting to see what's been happening with the numbers from a price reduction standpoint. you actually need to get up to the beginning slide. Sorry, I was going through and reviewing everything, but this covers the week of October 26th through November 1st. So this is the most current and up-to-date information that I can give to you based off of data that went under contract last week. And so I went through and pulled all of these numbers yesterday afternoon. And here's my crystal ball looking into 2023. And so I think that when we look at this, this is a heat map that tracks active inventory inflow and outflow of business down the left-hand side of the screen, odds of selling, percent of close to list price ratios, days on market, median days on market, how many units go under contract in the first week, reduced listings, and median sales price changes. And so what happens is up here at the top is your target listing month. And then here's your target close month based off of what average days on market are. I back into this data because this is based off of closed data. This is comprised of over 800,000 rows of data. And this is based off of data from 2013 through 2019, where we were in a similar level of inventory. And so where we had roughly about 2 months worth of inventory into our marketplace. And so right now, usually for the month of October, we have about 1.7 months worth of inventory. We're sitting about 2.1 months worth of inventory right now. So we're kind of in the ballpark of what we're looking at from 2013 through 2019. When I go through and do my projections for next year and try and set up my baselines, I'm really going to look closely at what happened in 2019 when interest rates were higher, but I'm also going to throw out 2020, 2021, and 2022 because they were such exceptional years in real estate that they no longer apply to what's happening. Keep in mind, we're still in a deep seller's market, but it's not the seller's market that we were experiencing for the last 2 or 3 years in a row. We went from going 120 miles an hour to the speed limit. And so it's going to feel like a bigger shift right now than it has in the past, just because of our perspective of what we just went through. But I'm really looking at March, April, and May being our target timeframes for when people buy and sell real estate, going into next year with April being our hotspot based off of data from 2013 through 2019. Looking into late July, when our market really starts to transition after 4th of July is when it's going to cool down, unless we do have those interest rates come down at the end of I've heard rumors that interest rates might come down in the second half of 2023 if we can get inflation under control. What are your projections on that?
That is like the mystery question, right? And I love this chart, but and this is more of the pre-COVID years. I almost see like 2024 being more of that standard set of data practices, right? As far as the seasonality that we can expect, because you're absolutely right. So there are people that are still thinking that we might see some interest rate drop this year. I don't believe that at this point, and we're going to show some of those numbers. But next year, I really do think if the Fed pushes the Fed rate up through March, and we see that we finally tip over, I was using one of those visuals, you know, that little bird that tips his head in the water and he finally splashes over. Like that's what needs to happen. We need to get enough of that additional cost to get the economy to slow down. When inflation slows down, we will see interest rates drop. I'm hoping that we go into the recession the second half of next year.
Okay. Great. Yep. And so usually in conjunction with the recession, interest rates drop to stimulate spending. And so hopefully we'll see that happen in the second half of 2023, which could spawn this, and it could completely throw all of my projections out of whack because again, this is an abnormal year.
I mean, it could push all the red like into the fall.
It could push it into the fall, definitely. And so we could start to see that happen. Here's the heat map for 2022. And you can see that we were really on fire for about the first 5 months of the year. And as we continue to tack on roads for the inflow and the outflow of business, that our strategy sheets continue to cool down. And I think this is a great visual for showing your clients. And again, it's really hard to have these conversations with your clients and let the data be the bad guy. You're not the bad guy. You're the one that's here to give them the information about what's happening in the market and to give them a realistic projection of what's going to happen as we get into the lighter part of 2022. And so looking at what's happened over the last week, our predictive month supply of inventory popped up to 2.1, which is the highest it's been since about 2019 when interest rates went up from 3 to 4.5%. And that happened right around October of 2019. Our average daily active count came down by about 0.6%. We're now sitting at 7,100. When I pulled that number going into this next weekend, we're down to 6,900 available homes to be looked at this weekend. And so we did start to see some of that purge of the expireds and withdrawn transactions. Expired listings were 423 that expired at the end of the month based off of the way that you guys write your listing contracts. Usually what happens is that you end up seeing that There's a big purge that happens at the last day of every month, just based off the way that you write your listing contracts. And so expired transactions ended up going up 118% over where we were just 1 week ago, and they're up 139% from where we were 1 year ago. So there's an initial purge of our expired and withdrawn transactions. That number continues to go up as we go into November, the end of November, and the end of December. The end of December is really a big time for those expired listings. But again, for those of you that farm those expired listings, there's 423 people out there that might not have been marketed right, that may benefit from you relisting their property now, or relisting it again in the springtime, hopefully when we see the big pickup of our transactions. Withdrawn transactions they actually fell by about 1.8%, but they're up 104.7% from where we were 1 year ago. Back on market transactions fell. We only saw 247 units come back on market. That number will likely jump as we see some of those expired and withdrawn transactions going into next week for people that really do want to sell, that may be changing or swapping out their listing agent, trying to get their home under contract. Pending transactions this week fell by about 7%, and we're down by 41.7% from where we were 1 year ago in terms of pending transactions. So there's a lot less business to go around right now. And this is where you have an opportunity to differentiate yourself. It takes a lot more work to get units under contract right now, where you're having to go through and do your marketing updates, and you may be having to give your clients a weekly update on what's been happening with showing activity and with transactions. And so this is a great report that you can send off to your clients to talk about what's happened in the last week based off of data that went under contract just in this last weekend. But again, we're continuing to watch the market cool up to 2.1 months worth of inventory. And again, it's been since 2019 since we saw that number. The odds of selling dropped down to 44.4%, which is the lowest that we've seen that in the last 3 years also. And so again, if you're listing a property this next weekend, the likelihood of it going under contract in the first month is about 44.4%, down from that 87.3% that we saw back over Super Bowl weekend. And so the odds of selling has really tapered off as our buyer pool has cooled in light of affordability issues with interest rates going up. And so again, our market has cooled substantially. We're still not close to a balanced market. We only have 35.4% of a market in balance. We are seeing falling prices. We are seeing homes that are going under contract for less than asking price. This is a market correction that's more severe than just the seasonal correction that we experience typically from July through September. Typically, we end up seeing prices fall back by about 3 to 5%. This year, they've fallen back by about 9.4%. So if you're using those comps back from April, May, or June, you're off by 9.4% from what that list price was going to be. So it's really important that you're pulling back in that initial asking price, and it's taking a lot longer to get these properties under contract. Showings last week ended up declining by about 1%. We had about 10,500 showings that were set over last weekend, which makes you have about 1.5 shows per property per week in that particular price range. I'm still struggling with broker bay data. It's not friendly towards me. I can't get that information out of the system the way that I need to in order to pull the showing time report. But again, it's only about 10 to 15% of listings are set up on broker bay right now. So we could probably add 1 showing to this per week based off of data from broker bay, but it's about 1.5 shows per property per week. Based off of data from last week, it's now 14 showings to go under contract. So buyers are being more picky about what they're looking at. They don't feel their feet to the fire like they did earlier this year, where they were pulling the trigger and putting properties under contract where they were looking at only 10 houses before going under contract. Now we're looking at 14 showings to go under contract at this point. So if you've had a total of 14 showings and no offers, it may be time to make a price reduction at that point. I had a really interesting conversation with an agent who's been in the business for a long time, who was talking about price reductions, saying, 10 years ago, we would wait 2 to 3 months before we made a price reduction.
Right.
And before we would go under contract. And so again, stretch out the time that you're waiting to make those price reductions, because it's taking longer for these properties to go under contract. And maybe more marketing materials is the solution, and not just going through and slashing prices, because I'm seeing a lot of fire saling that's happening right now. And instead of doing that, increasing your postcards, increasing your pay-per-clicks on social media to market that property, going through and doing more of that social media activity to get that home out there. Open houses are a great way to go for getting properties under contract, rather than just going through and slashing prices. But it seems like the only thing that we know how to do is how to cut prices. And that may not be the solution at this point.
It's perspective though, right? I mean, we just went through a really hot period of time, and so now everybody wants to generate that heat. versus 10 years ago coming off of a bust. I mean, the elongated on market times were normalized. And now you're like, okay, well, after a couple months, it still hasn't moved. I want to do price reduction. Now we're so used to everything changing so quickly. I wanted to double click on something you just said a minute ago. So I think it's so apropos, because one of the things that Powell keeps talking about is the fact that the housing market does need to go through a reset. It is one of the bigger indicators of the inflationary market. But he was talking about the fact that when you had said that the price drops were 9.4%, he's talking about slowing down the intensity that we'd had over the last 2 years. So if we had gained 44% over the last 2 years, pulling that back 10% is normalizing an overheated market. But everybody keeps thinking about it as a loss. Now, if you bought at the beginning of this year, it is a loss. And I get that. And that's real. But if you didn't, and you've been holding that home for the last 3 years and you gained 44% of value and then lost 10%, it is simply going back to a rebalancing, right? I mean, we have to talk to the sellers differently if the seller bought earlier this year or if the seller bought 5 years ago, but it is something to keep in consideration.
It is. And I expect there to be negative appreciation as we go into the beginning part of next year, hitting that $820,000 average sales price again at the beginning of the year. I just don't think it's going to happen. Right now, we're sitting at about a $770,000 average sales price right now for closed transactions based off of data from last month. And so I just don't think that we're going to hit those numbers again, because we're not going to see that remarkable run up in the beginning of the year like what we've seen in the past 3 years. And so again, we're going through a market reset right now where those home prices can fall. But again, we've gained so much over the last 3 years that there's room for correction in our marketplace without people taking a substantial hit and seeing the entire market go upside down. And so looking at median days on market for units that went under contract last week, it was 26 median days on market, which is a gain of 5 median days on market for homes that went under contract over Halloween weekend. And so I know that I was busy out there with a lot of Halloween activities with the kids over the weekend. I mean, we had parties going on all weekend. And so it was probably a drop off in buyer activity due to Halloween weekend. I mean, there were parties and birthday parties and trunk or treats and everything to take the kids to this last weekend. And so again, a lot of people took that time off in order to go and spend that time celebrating the holiday with their kids. And so 26 median days on market. So if you've been on the market for longer than 26 days, you're in the bottom half of the market, it may be time to consider a price reduction at that point. So again, it's not the 4 median days on market that we experienced for the first 4 to 5 months of the year. We're now at 26, so it's taking longer to sell these properties. So slow down the rate at which you're making price reductions. Speaking of price reductions, it was 57.4% of what went under contract last week made a price reduction. That number is really substantial. That's up 7.4% from where we were 1 week ago. We've been hovering around about 50% making price reductions previously, but this last week, again, those sellers that want to sell are really serious and they're dropping their prices like crazy to get under contract right now.
Do you remember the last time you saw that number?
Oh my gosh, the last time I saw that number was back in 2012, where we saw substantial price reductions. And I mean, that was back in 2012, we saw price reductions hit about 54%. And it was like May of 2012 that we saw substantial price reductions like that. And so again, these are really substantial, really widespread price reductions. And the size of the price reduction was about 7.9% or about $54,000 off of the original price. I'm a bigger fan of making one big deep cut to get back in front of the market rather than chasing the market down with a series of smaller price reductions to show that your seller is serious about selling their home, but it is a substantial price reduction right now to get it under contract. Looking at homes that are up to $500,000, our heat map is showing that cooling trend settling in for 2022. Also blue cells creeping in, showing that the market has become less competitive than what we've experienced over the first 4 or 5 months of the year. Month supply of inventory stretched out to 1.5 months worth of inventory. So for every one buyer out there, they have about 1.5 homes to choose from. We have just under 2,000 available units for sale in this under $500,000 market. Pending transactions fell by about 4.4% this last week. Expired listings, so here's our purge. Expired listings, there were 98, so that was up 127.9%, and it's up 58.1% from where we were 1 year ago. So we're starting to see that purge of expired transactions. We need to see a bigger purge in order to get our numbers down to have that that big spring takeoff again. If we head into next year with high interest rates and high inventory, we're likely to continue to see these widespread price reductions at larger amounts to try and get properties under contract, which would be fueling the negative appreciation that we see going into the beginning part of 2023. Looking at where we are for the odds of selling, we're now down to 53.5% odds of selling. So if you list a home in the next week, you've got about a 53.5% odds of selling for units to go under contract in the first month that they're listed. We're still only sitting at about 24.2% of the inventory that we require to offset demand. So we're close to a market that's going to go into a negative market, where we're going to see a bigger correction than where we're going to see a transition into a buyer's market. We're looking at about 2 shows per property per week in the under $500,000 market, with just under 4,000 total showings that were set last week. We saw about 13 showings to go under contract. So if you've had a total of 13 showings and no offers, then it may be time to make a price reduction in this market, with about 21 average days on market. We saw 21.5 about 2 weeks ago. So again, it's taking about 3 weeks for these units that are under $500,000 to go under contract. Price reductions also tipped over 50% this week for this under $500,000 market, which we haven't seen happen yet, but it was 52.3% of what went under contract last week made a price reduction, and the average price reduction was about 7.5%, or about $33,000 off of the original price. This is really the meat of our market in the $500,000 to $1 million segment, with about 60.2% of our homes falling into this particular price range. Again, here's our strategy sheet going into $500,000 to $1 million, and you can see the cooling trend has really settled in, really started happening back over Easter weekend, where our market started to cool down. Our month supply of inventory popped up to 2.3 months worth of inventory. This is our most interest rate sensitive category, with about 85 to 90% of these borrowers requiring financing to get into these homes. And so I'm seeing a lot more advertisements of 3-2-1 buy downs, 2-1 buy downs, rate buy downs, permanent buy downs in this particular market to try and sweeten the deal. In this price range, it's about 50% of them are offering concessions, with an average concession of about $5,500 to go under contract, and covering the cost of closing for those people that are going under contract in this particular price range. We have about 4,100, 4,200 average daily active count, which came down by 1.5%. We did see a jump in our expired transactions, 266 units expired, which was up 125% week over week. And that's up 228% from where we were 1 year ago. So a lot more listings out there to be expired. Withdrawn transactions actually fell by about 4.7%. Pending transactions are down 4.4%, down 33.9% from where we were 1 year ago. So there's a lot fewer transactions out there to be had as we get into the fourth quarter. The odds of selling dropped down to 42.2%. So if you're listing a home in the next 30 days, you've got about a 42.2% odds of selling. I expect this number to fully continue to drop off as we get into the later part of the year and as we get closer to the holidays. I don't know about you guys, but I'm putting up my Christmas tree pretty soon. And as soon as those holiday decorations start to come out, we end up seeing that there are fewer homes that are listed as we start to get ready for those holidays.
Home Depot's already got the trees and decorations out.
Oh yeah, definitely.
I'm
Well,
sure
they've been out for a while. So I know my mom was
ready.
trying to pawn off an extra. She's like, I have an extra Christmas tree. Do you want it? I'm like, stop pawning stuff off on me, Mom. I know I've got room for it, but I don't want it. I don't want more stuff and more clutter. Stop.
Do you have a tree, or do you
I
get a live
I have a
tree?
huge tree.
You have a huge tree.
I have a 12-foot tree that goes up, and so it's the boyfriend's gonna be helping putting that up. So
nice.
Yeah, gotta get. I don't own a ladder, so I might be having to get a ladder this year to get that put up. I had my handyman help me last year get my tree up, because I was like, "You have a ladder? Can you come over and help me put my tree up?" And paid him extra money just to come and help me string some lights along my tree. But looking at this market, we're now to 40% of a balanced market. So this market is the one that's trending closest to getting to a market in balance, but we're still not to a balanced market yet. We would need to have about 10,800 units available for sale in order to get to a market in balance for the $500,000 to $1 million mark. We're looking at about 1.3 shows per property per week for homes between 500 to $1 million, and it's about 13 showings to go under contract in the 500 to $1 million mark. So if you've had a total of 13 showings and no offers, it may be time to go through and make that price reduction. Median days on market, check that out. 31 median days on market now for 500 to $1 million. So we're looking at just over a month for homes to go under contract in this market. So if you've been on the market for 31 median days or longer, it may be time to go through and make that price reduction at that point. Price reductions were huge for units going under contract this last week. We saw 62.8% of our homes make price reductions for units that went under contract last week for 500 to $1 million. And the average price reduction was 8.1%, or about $62,000 off of the original asking price. So really substantial price reductions for 500 to $1 million. In the $1 to $1.5 million price range, this only represents 7.6% of our inventory. Looking at our heat sheets, you can see again, our cooling trend really started to settle in as we went through April this last year. We're now sitting at 3.2 months worth of inventory. That number is bobbling around a whole bunch. I wouldn't be surprised if that number comes down this next week just because of the holiday weekend with Halloween going on this last weekend. I think it really slowed things down as people were celebrating Halloween and getting out to all of the costume parties, but we were at 3.2 months worth of inventory in this market. We had 524 average daily active units, which fell by about 5.2% week over week, but we're still up 94% from where we were 1 year ago. Expired units jumped by about 70% week over week, and they're up nearly 90% from where we were 1 year ago. So there's that purge of expired transactions that we've been looking for in this market to hopefully drive our inventory down a little bit before we head into our next year. So hopefully we get a little more of a jump off towards the spring months going into 2023. Back on markets were up about 10 units came back on market, which was a jump of 66.7%. And so the fallout rate for units between 1 to 1.5 million ended up being about a 10 to a 12% increase in back on markets for units falling out of contract. The odds of selling came down to 35.8% odds of selling. So if you're listing a home in the next 30 days, you've got about a 35% chance of it selling in the first 30 days that you're listed. This market is now up to about 35.2% of a market imbalance. We would need to have about 1,488 homes to create that magical 6-month supply of inventory. We're looking at about 1.3 shows per property per week for homes between $1 to $1.5 million. And it was about 18 showings to go under contract. So people are being much more discerning about looking at these homes before they go under contract and exercising their time and their ability to go through and negotiate on these transactions.
Because even if it's not an interest rate, it's still $100,000 they can get off, or $200,000.
Right.
Yeah, makes sense.
And so we're looking at 28 median days on market in this particular price range. And so that's up week over week by about 12%. So if you've been on the market for 28 days or longer in this price range, it may be time to make that price reduction. Price reductions weren't as high in this $1 to $1.5 million market. We only saw 40.5% of those homes make price reductions, but the price reductions that we saw were about 6% this last week, or about $77,000 off of the original price. We saw some much more substantial price reductions back here over Labor Day weekend, where it was up to 11.1% of a price reduction. Now we're seeing about a 6% price reduction at about $77,000. 1.5 to 2 million. Now this only represents about 2.8% of our overall inventory. The cooling trend settling in as we get deeper into those winter months. As we look at the 1.5 to $2 million price point, we're now up to 3.9 months worth of inventory, which seems high, but I like to compare this back to where we were back in 2007. Back in 2007, before the market crash really settled in, we were sitting at 12 and a half years worth of inventory. So again, a 3.9 month worth supply of inventory for 1.5 to 2 million overall isn't bad, but it's substantially higher than what we were experiencing earlier this year. We have about 203 units that are available for sale in this market. That declined by about 0.5% this last week. 12 units expired, which was an increase of about 200% over where we were the previous week. And it's up 20% from where we were the last week. 6 units withdrew, and that's an increase of about 50% week over week and up 200% from where we were 1 year ago. Back on markets, there were 9 units that came back on market, which was an increase of about 50%. We didn't see any back on markets the same week 1 year ago. The odds of selling is up to 36.7%, which is still better than where we were as we went into the pandemic, and better than where we were at the very beginning part of 2020. And so these numbers are still pretty strong in terms of looking back over the last 2 to 3 years. That's right about where we should be for the month of October. We're sitting at about 32.4% of a balanced market. We should have 626 units to create a balanced market for homes between $1 to $1.5 to $2 million. We're looking at about 1 show per property per week, 1.1 showings per week in this particular price range, 19.1 showings to go under contract in this price range. So again, people are taking a much more close look at these properties before putting them under contract. So if you've had 19 showings and no offers, then it may be time to go through and make a price reduction. Median days on market really stretched out this last week. And so it jumped up to 51 median days on market for homes between 1.5 to 2 million, which was up 45.7% from where we were in the previous week. So we're starting to see some of those aging units that have been on the market for a long time start to go under contract. We saw 45.5% end up making price decreases, with an average price decrease of about 10.6%, or about $195,000 off of their original price. And so some pretty substantial price reduction activity has been happening in our market this last week. And so again, interesting to see some of those numbers coming through as we start to look at what's been happening over the last couple of weeks. We got about 5 questions. If a buyer is paying top dollar in today's market for a fully flipped turnkey condo and prices really dip in the time interest rates lower, will it be difficult to refinance to a lower rate if the house is upside down? How can we advise our current buyers on this?
So most times you're putting money down. So if you're putting 10%, 20%, 30% down, then you shouldn't have a problem with appraisal. But if you're putting minimum down, you're putting 3% down as a first-time home buyer, 5% down, and prices drop, especially condos, which we know can drop a little bit deeper, you could see that you'd have to bring money to the closing table in order to refinance.
You said $770,000 average sales price. Is that specific to Denver proper? That's the 7 metro Denver counties what I track. You have the numbers for the DMAR report for the 11 counties. Do you remember what number was for last month?
So not off the top of my head. No, but
okay.
We did just send that out. So there was an email that went out at 7 a.m. I know DMAR sent out their email as well. So that report is live. Yeah.
I just accidentally deleted a question that was for price reductions. Would you recommend making a price reduction over election time? I would say yes, make a price reduction sooner rather than later, because the odds of selling is going down as we get deeper into the year. And so I would recommend making that price reduction sooner rather than later. Do you record this and stick it on your YouTube, correct? We actually email out a copy of it. So if you're registered for today's webinar around 11:30 to 12 o'clock today, I'll be sending out a copy of this recording. It's at the very bottom of the email. Oftentimes I get a request from the email that I sent out with the recording saying, do you have a recording of this webinar? And if you just scroll down to the very bottom of that email, there's a recording in there, as well as the ability to download all of these reports. Is there a reason that you track median days on market versus average days on market? Median really represents the middle, and it throws out the really high and the really low. So it's a better gauge of what's happening in the meat of the market. So I'm looking at the point at which 50% of all the homes are under contract, rather than looking at average days on market. The downside to those sellers waiting until spring will be pricing off the fire sales happening now until the end of 2022, substantially down from the summer. Where do you see available unit count come January? We had roughly 1,400 last year. I think we're going to be closer to 3,000 or 4,000 available units for sale as we get into January and February. I don't think that we're going to see that big drop off in transactions like what we've seen previously. So I think that we're going to go down probably 3,000, 4,000, maybe even 4,500 as we get started into next year. I think last week you had mentioned a number we could text to get updated interest rates. Would you mind sharing that again? So Nicole, what's that number?
It is, and I have a sticky note on my desk. It is 855-930-0377. And if you text update to that number, 855-930-0377. And in fact, we just sent out a text yesterday talking about exactly what the Fed did. We recorded a quick TikTok and Instagram video, and then we sent out an update to our text. So if big news comes out, like the Fed meeting, we are going to let you know. Or tomorrow, tomorrow is Friday, so we'll be sending out that Friday text as well. But unemployment numbers come out tomorrow. I don't expect that they're going to surprise us. I think that it's going to be either flat. I don't know that it could be down, but it could be. Job numbers came out strong, and that's part of this whole economic strength that we've got going on right now that could even lead to interest rates going up further.
And so will you say that number one more time?
It's 855-930-0377. And we send out an email as well to this whole group. I know Megan does, so you'll get 2 emails.
Yep.
Although we partner on a lot of things, we are individuals, lender, title. Right?
Yes.
So we will send out the individual emails with a link back to the Agent Ignite Facebook group, which is where I put the exact same video. So Megan will send it out from her platform. I'll put it up on our Facebook group. We'll put the number to the text update as well. And then we've got all the videos and the PowerPoint presentations and everything up there.
Awesome.
Yeah. All right.
Let's have Nicole kick it off.
And I know while we're talking, if you want to jump on Facebook, we had a lot of banter, which was fun. Yes, you guys are.
I'll get on Facebook and start answering those questions.
Fantastic. Well, it's been a wild week, right? And I said that it would be last week when we sent out the Friday update, when I did the Saturday. I had a little bit more of a loan program bend to it. I had a couple of people ask me, say, I get your Thursday emails, but I don't think I'm getting your Saturday. The Thursday emails aren't part of our campaign. It's not part of our CRM. We're just simply emailing those of you who signed up for this presentation specifically. If you get my email, you're not on my distribution list if you get the Thursdays, but if you want to start getting the Saturdays, where we go into a little bit more detail on maybe something that's going on in the market. Certainly I'm going to be talking about the unemployment numbers. I had double the number of slides to show you today because a lot is going on. And of course, we just sent out our market trends, our DMAR market trends video and report this morning, which talked about something totally different than what I'm talking about today with Megan, because what we're talking about with Megan is I'm talking about what the Fed did, what interest rates are doing, and how the economy is doing. This morning, that really was focused on housing. It was focused on demand and supply, affordability, and credit availability. I talked through those 4 things on this morning's video and narrative and breakout and blog. All of those were sent out this morning. So I know there's a lot of content going out today. It just so happened we overlapped with the DMAR's release of their market report. So I'm going to jump in here, but there's all these things that are talking about the strength of the buyer, the strength of the housing market, and why not only can the housing market not really lose an immense amount of value. We already talked about the fact that Powell has been wanting this reset, right? Powell has been wanting this correction or this rebalancing. He's been pushing towards this by raising the Fed rate, ergo raising, and the inflation numbers being high in the 30-year fixed coming up right behind it. He knew or had to know, and he'd said it earlier on, that housing could be the sacrificial lamb. We had a very strong, almost an abnormally strong 2 years where sellers could really name their price and get it. And you could say that sellers were greedy. I think sellers were taking advantage of an opportunity to sell a product at the highest price. Who doesn't do that? But now Powell is saying we need to rebalance this, the balance between supply and demand. We need to correct what was done over the last 2 years. And this is the pain that we're feeling. Now, again, remember, a lot of the rest of the economy is not feeling it yet. We're not in a recession yet. We're talking about the recession coming in the second half of next year. And when that happens, we will see rates drop. Now, if the recession is slow to go, which based on the strength of the economy, it could be, we could see that interest rates don't drop until 2024. That's what I'm talking about, the fact that I really want it to happen middle of next year. I mean, we all really want it to happen. Like we really want it to happen right now, but we might actually see interest rates go up further. We could see them hit 8%. So let's jump in a little bit on what's going on in the economy with the Fed conversation. And I'm going to show my screen really quickly. All right, here we go. So, right, the rest of the economy is not feeling this. Meeting your buyers where you're at, asking a lot of questions, finding out what's important to them. We were doing some scenarios here in my office yesterday, as well as with some other real estate agents, talking about how do you address this question? How do you tame a fear? How do you get a buyer or seller engaged? What you can't do is push. You can't push somebody that's already experiencing stress. They're simply going to run. What you have to do is ask the questions as to where they're at and what's important to them. Don't think about your next 2 months or even really your next 6 months. I'm hoping you saved a little bit from the last 2 years. What you've got to start doing is put your clients in a pipeline throughout next year, creating a space for them to come back to you without the added stress and pressure. What are your long-term goals? What are you hoping housing helps you achieve other than just a roof over your head? How can I help partner with you to achieve those goals? It's a change of conversation, a refocus and doubling down on the things that work. It's a consistency of marketing and messaging, and making sure that you're using the vehicles that relate to your clientele. Like social media might not be the clients if you're, or might not be the mode if your clients are 70 years old, but it might absolutely be, and I'm not going to say Facebook wouldn't even be the mode that you would use if most of your clients were 30 years old. So figuring out how to stay in front of them, how to stay communicative, and how to stay relevant right now while they're waiting out what's going to happen, because their shift is coming next year. We are going to see more job loss. We are going to see the unemployment rate go up. We are going to see things tick. And that's the very thing is going to allow the Fed to come to pull back from its increasing the Fed rate. So first, before we get started, like, okay, show me some energy. Come on, do it. Come on.
I'm answering all the Facebook stuff, but I'm excited for this. This is going to be great.
So come on, like you can't tell me that on February 2nd, you're not going to be like, right? Like, hell, like I made it through 3 months. I haven't had a client call me. I've been doing all the messaging. I need like a resurge of energy. We've got the energy. We're bringing it. I mean, we've got Nick, who I'm not even going to say his last name. As you might know him, he has no legs. He's got one arm. He has traversed the China wall. He has climbed 14ers. He is all about no excuses. You are going to be crying. You're going to be feeling extreme energy. And then going into some of these other, to end with Molly Bloom, to have Eric Wall in the middle, to have Renee Rodriguez. I mean, we've got some power players and we've got real estate content in between. So we've got 4 speakers on real estate content. We have 3 high energy motivational speakers. This is the event. If you prepaid, and then I'm going to go on to the economics. If you prepaid a ticket, you should have received a golden coupon in the mail. We snail mailed it. And so this was to you to bring a friend with a $50 off coupon. There are no coupon codes this year. We dropped the price. We were going to go to market for $4.55. We dropped it to $3.95 given the economy. I gave everybody the coupon code. There are no coupon codes. But if you believed in us and you prepaid your tickets last year, the next big thing, we're doing something a little bit special so that you can bring a friend. If you know somebody that went last year, you might want to belly up. I'm just saying. All right, here we go. So let's talk about what's going on in the economy. These first couple of slides are going to go fast because really it's the message behind the slide. Don't get caught up in the number. Recognize what's happening right now in this economy. So the consumer price index, the PCE, both of them, this is CPI and the PCE. This is coming out next week again. The CPI was high. It's still high. It's dropping slightly on a headline number, but the core is still high. They're still watching this. Remember, the Feds want a 2% inflation rate. Dude, we're at 8. Come on. Now the PCE is a little bit lower than the CPI, but still they're going for 2% and they're hyper-focused on this and they keep talking about it. This is the driver. This is the single mandate at the cost of employment. That's it. It's that simple. It's one sentence. Just shove inflation down at the cost of employment. We're waiting to see unemployment numbers go up. That will be the trigger. So all of the things are still up. The economy is still strong. JOLTS numbers came out this week, actually up almost just shy of 500,000 job openings. Who's hiring right now? Companies are hiring. Companies know that other companies are laying off. They're grabbing up good skilled workers because it was so hard to find workers in the last 2 years. And the ones that do have them are holding on. So JOLTS numbers went up. Now, don't take this with a little bit of a grain of salt because those workers who are across the country, you might see multiple job openings for the same actual job because you can work remote or work from anywhere. So the JOLTS numbers went up. ADP job numbers went up yesterday. We've got the job numbers coming out tomorrow with the unemployment number. We'll be sending out a text talking about that. Our rates text won't come out obviously until after that. So the ADP numbers went up 239. That was above the estimate of 195. That's great for the economy, bad for our interest rates. I'm just going to show you a theme here, right? GDP numbers up 2.6%. As you can see, it was down the first quarter because of supply chain issues. It was down a whole lot less the second quarter as consumers still continue to spend. And now it's actually up. I mean, how many of your friends, and I've said this before, and I'm not going to say it again, how many of your friends were in Switzerland last month, or even this month, or going to Ireland, or going overseas? I've got several friends on a cruise right now. People are still spending. Americans love to spend. Confidence ticked back up. Look at that. So we're saying, okay, I see it. It's happening. It's not so bad if I've got money saved. I still have my job. We talked about this. If you stayed at your job, you got a 7% on average raise. If you job hopped, you got a 15%. I mean, we're not feeling that in this industry. We are very focused on interest rates. That's why we felt it first. And that's why we're going to feel it hardest while the rest of the economy goes through this and we go through this recession, which many are saying is going to be short-lived. But that's the problem, right? That's the problem. Nobody's not spending because everybody thinks it's short-lived and I got enough savings to offset this. Car sales, we're back up again. People just stop spending for a minute.
You guys are because there are finally cars out there to buy.
There are finally cars out there.
We haven't had cars to buy for the last 2 years.
That's so true. So theme, I'm just showing you theme, right? You don't have to get hung up on the singular thing. It is like all these things are up. Jobless claims went down. Now that's actually the exact same thing, same theme, but down means less people filed for unemployment for the first time. So the continued jobless claims actually went up because those who have been laid off, especially if you're in the real estate or the mortgage space, you're staying unemployed because nobody's hiring processors right now or closers right now, or maybe real estate professionals who are salary based right now, right? Unless you want to change industries. So, but jobless claims, those people who were let go and initially filed for unemployment, that number dropped 1,000. This is the number. Every week we're watching this. When this goes up and when it goes up consistently over several weeks, this is the trigger that tells the Fed they can stop raising the Fed rate. This is it. I'm giving you the keys. This is the number that we have to watch every Thursday, because when we start to see more job loss and when we see unemployment go up, their target is 4.4%, we will start seeing the economy work its way into a recession. And then we're going to see some relaxation of the Fed rate, some relaxation of the bond market, and we're going to start seeing interest rates settle down and kind of get out of this whole volatility market that we're in right now, which is exhausting. Yesterday was exhausting.
Meet you at the bar.
Yes. Yeah, we're gonna celebrate when that happens. So Nick Timmeros, I've mentioned him a couple of times. He's kind of like the canary in the coal mine. So down here a week ago, he had said that, you know, the Fed is hearing it. Congress is going to talk to them. The Fed board members are talking to them. We're going too hard, too fast. Maybe we need to pause. That's when the market celebrated for a minute, right? We saw some uptick in the stock market. We saw our bonds relax for a hot minute. And then he came out right before the Fed meeting, goes, oh, wait. No, what we're actually saying is that we might have to hold it for a little bit longer because Americans are cash heavy, right? So remember, he's got the voice, or he's got the ear to Powell's voice. So when he was over here, and what he had said a week before is kind of what was in the written notes before Powell took the stage and answered Q&A, that we might see a pause, that we have been going hard and heavy, that we might want to settle and let the metrics catch up. So, and then all of a sudden the day before, now all of a sudden the messaging's changing. The Q&A definitely reflected this most recent article talking about the fact that we have a very strong economy and we need to get unemployment numbers up so that we see the job recession coming in. So the balance sheet's strong. What does this mean? This means that we're still seeing 1.7 trillion in excess savings. So a lot of that is at the highest wage levels, right? The highest net worth, but we're still seeing 350 billion in excess savings, even at the lower net worth levels. And this chart is just showing you that yes, people are spending, but the black arrow is showing a net positive for all net worth. We're flat even at the bottom quartile, and then we start going up. So people are still have more than they're spending. Yes, we're seeing credit card debt go up, but people still have more than they're spending right now. That strength of the household finances and the job numbers being strong are what's allowing the Fed to press the gas on raising the Fed rate. We also are seeing, and they're watching this, Fred's got the charts on the household debt, right, as a percentage of disposable personal income. It's still near lows. So is mortgage debt. I know we're talking about affordability, but don't think about the first-time homebuyers that can't get in. We're talking about the 40% of homeowners who don't even have a mortgage, and the rest of those homeowners, how many of them, 86% of them have a mortgage rate below 5%. Their affordability and their mortgage payments are low. The people that are trying to get in now are struggling with true affordability issues. So he did what we expected, right? He got up, we're doing the 0.75. We had the notes from before the speech started. And then for 30 minutes, he went hawkish, super hawkish. Like he had been in the written notes, he'd been dovish. And what am I talking about? When dovish means that he's going to be more calming, right? He's going to have more pause. Hawkish means they're going all in. They're going to exercise their monetary policy. We're going to start seeing them do the things that they need to do to get the job loss to take hold so they can stop raising the Fed rate. All of this in efforts of controlling inflation. He knows and said multiple times, I know that the housing market is feeling pain. Right? We are seeing this in the housing market, but ultimately there's a lot of wealth in the housing market. So he's okay with that. So here's the comments that actually threw. So I got a number of texts this morning, number of emails saying, so where interest rates good? Are they where they were? Because I saw that they only raised it 0.75. Yes, no, they're not. They're going up. So now we're seeing those interest rates go up as the 10-year treasury goes up. And I'll show you that 10-year treasury in just a minute. But a couple of these comments, we said, those investors who came in thinking that we were going to pause are premature. We're not there yet. He's also saying that the ultimate level of interest rates will be higher than previously expected, because previously they've been talking about 4.5% is where they were headed. Now they're talking about 5 to 5.25. So I'm going to show you that in a second. We're going to get there by March, especially if he keeps going the way he's going. He also said that the path to a recovery without a full-blown recession has narrowed. It is going to be harder to find the path to not have a full-blown recession, given what we need to do to accomplish the reduction of inflation. So kind of buckle up. Family and businesses are going to have pain. He's been very clear about that. Now, speed is becoming less important. What he's talking about there is the speed by which he's going to raise the Fed rate. So we just had 0.75 interest rate hike. Expect a 0.5, could even drop to 0.25, but I expect a 0.5 in December, late January, February, 0.5 to 0.25, March, 0.5 to 0.25. And that's what we're looking at. When we're looking at the Fed watch, we have 3 rate hikes left: December 14th, January 30th, and February 1st, and March 22nd. So with the goal that we're going to hit 500 to 5.25 and then stay there. This is the key. Everybody's asking, what do you think interest rates are going to do? What is the housing market going to do? Everybody's going to have, I mean, we're at the end of the year. Everybody's going to have their predictions on what we expect. But ultimately, it comes down to, I'm going up high, and now I'm going to stay there. How long does it take the economy for Americans to stop spending, people to lose their jobs, before we start seeing those initial jobless claims go up and the unemployment numbers go up? How long until we start seeing the pullback of the consumer spending and really the wages? We had to see people laid off and then people going to get jobs for a lower salary. That's what it's going to take. So how long does that take? Is it going to take a couple months? It could be the second half of the year. Is it going to take 8 months to get there because people are going to hold out for the perfect job? It could be the beginning of 2024. Now, I'm still banking on the fact that it's the second half of next year is where we're going to see the recession. But this is the nuance that we're going to have to continue to just watch and talk about. So I guess we're going to be doing this every week for the next year and a half. So yeah, there you go. There you go.
Yeah.
All right, we have 7 minutes left. I'm going to run through these. So the stock market dropped. We saw 2.5% down yesterday. We saw the 10-year go up. It was at 4.01 before the Fed talked, before Powell came out. It went up to 4.2. That is a significant hop. And now it's hovering around 4.15. What does that mean? Right now, we're seeing interest rates hovering around 3 to 3.5%, even higher. So at this morning, it hasn't fully set in yet. We're going to start seeing that number go up. We could see 8. We could see 8. I don't think I could see 10. The economy just keeps saying, screw you, Powell. I'm going to keep doing what I want to do. And I'm going to hold on to my employees. And we've got enough money saved for the next year and a half. I don't know. Maybe it could go higher. I think realistically, 8 is probably the top. So what we're also seeing is this gap. Right. So this chart is a little bit hard to see, but I've got another chart right behind it. This chart shows this gap over here all the way to the right of the spread between the 10-year treasury yield and the 30-year fixed. That spread is what is the risk of the secondary market and what's keeping the interest rates high. Here's a different chart. This is actually the delta. So this is the difference between, and so you can see it usually hovers right here at 1.65 to 1.80 is the average. We're at 3 right now. So we're bouncing and we're going a little bit higher, and that just has to go with risk. I mean, these are all risk recessionary periods where you actually see that spread increase. Literally, the Fed could say one thing and drop that back to 1.65 to 1.8 and immediately cut 1.5 points off of our mortgage interest rates. You know what he could say? He could say, we're going to start repurchasing mortgage-backed securities. I just need one statement. They're not going to do it. They're not going to do it because they need to see inflation stop. They need to create pain. They need to stop this massive housing boom that we had. That's the statement. That's the thing. Right now, they're not doing quantitative tightening. They're not selling off, but they're not buying either. So we even saw that a couple of weeks back, a month back, we talked about when England started buying it for 48 hours, how it shifted the market. That one simple thing. They're not going to do it. They're trying to push it up, and then they're going to hold it there and wait and see what happens. After March, though, if they wanted to, they could start repurchasing to allow the economy to speed through the recession faster. So in the meantime, you're looking for opportunities. You're looking for those things, whether it's taking a class, teaching a class, learning a new product, talking to a new demographic or a new client base, or simply sharpening your saw when it comes to your blog writing, your video editing, those conversational tools that you're using to continue to educate without fear, without stress, talking about the housing market, talking about the turn, talking about the appropriate times. Because when trying to time the market, should I buy? Should I sell right now? We talk about the fact that it's a great time to buy. It's a okay time to sell, not a great time. You're gonna have to negotiate. Ultimately, trying to time the market is a fool's errand. What you've got to do is move on with your life and know that real estate is long-term, which is exactly what we also talked about in the video this morning, and know that over the long run, the next 6 months aren't going to matter. Right?
We're not day trading homes.
We're not day trading homes.
We're not day trading homes.
So we've got a number, you guys are finding some deals right now. I've got a number of real estate agents right now who are doing fix and flips or renovations. We have 2 very strong products, a fix and flip with 10% down and a renovation loan with 15% down, both for investments. I can do renovations on second homes and primaries too, but these are both for investments. If you want to know more about this, let's sit down and talk, because you guys are finding those deals. You're out there. Also, I'm doing a ton of either investor or home buyer classes. Now is a great time to put together a program, whether it's in person, online, or whether it's recorded so that you can repeat it. How do you fill your pipeline for the spring? Stop focusing on today. Keep working on the activities that you know is going to bring you the business later. Because the moment you get all freaked out about it is the moment everybody goes quiet. And then we talked about this a couple of weeks ago. It went up. So 4.73 is what you can get a 1-year treasury bill for right now. If you go on a Treasury Direct, I'm going to tell you, I didn't know about the I-bonds. Did you know about the I-bonds?
I've never heard of an I-bond.
I didn't know about the I-bonds. It's an inflation marked bond. You guys, I'm sorry. I didn't know about it because on October 31st just ended the period of time where you could actually get an I-bond for just shy of 10%.
Okay.
but it's still 6.89. Where are you going to get 7%? So this is something you want to go up to Treasury Direct and at least take advantage of this opportunity. If the Fed rate is high, that means savings rates are high, and it gives you opportunities to, take some of that money that you saved over the last 2 years and put it somewhere that's making more than 0.05%, I think is what the banks are giving you. Well, let's see if we've got any questions really quickly. We're right up against our 11 o'clock hour. Do you track north of 2 million?
I do in the monthly report, but I can't track it on a weekly basis because I'm looking at like 5 transactions. There's just not enough information there for me to go through and track that. I get the monthly report out to you by the 10th of the month at 10 o'clock in the morning. I'm hoping to have that out by Tuesday or Wednesday next week because I've got presentations that I have to give on Wednesday about what happened in this. And so we will go ahead and do that. We got a thank you. So you're welcome. My tree is up in the office. Awesome. I'm excited. I'm ready to get my tree up. I'm ready to decorate for it. Can you please provide your email so we can request that we get added to your info email address list? Yes. And so my email is maller, ALLER at firstam.com. If you are signed up for this webinar, you are already on my distribution list. And so you will be getting a copy of everything today. So you don't need to email me if you're already attending this webinar.
And Chris, I'll tell you, mine is super simple, especially if you need the number, Nicole at theruthteam.com, and the Ruth has an E in it, RUETH, and I hope you know that by now.
Yes. And then miss the number. Can you post here?
We're running out of time. We are going to send out an email. We'll have it in there.
Okay. And so let's see, I can't see how rate hikes alone will resolve our chronic inventory problems in Denver. JP's stated goal is to bring supply and demand back in balance, but he doesn't have a lever to directly address underlying issues that cause low supply, like slow pace of new build. Moreover, what is higher interest rate depress the pace of the new builds even more? So what is the driving at? Do you understand the master plan here?
I mean, that's a fantastic question. And he actually brought up new builds at the last conference. So not at this one, but the last Q&A. He did talk about the restrictions that localities are seeing in the permits, that the lack of new builds, and he was talking about the new build permits and starts. So he knows that that's also a problem. The rise in rates really isn't about creating supply. It's about squelching demand. He only has the one lever. And so that's going to mean, I mean, he's got multiple tools, but this is the one he's focusing on, and he can't control supply. He simply can't, and he knows it. So all he's trying to do is reduce demand to allow supply to catch up with all of that pent up new build that was in construction. Remember all of those construction numbers where those homes needed to come out to market. Those new homes will be coming out in 2023. You're also going to see a ton of new multi-unit development coming live in 2023, which is going to help reduce the rent, which affects inflation, which is going to help drop inflation. So that is happening.
Yes. Yeah. Okay. We got through all of the questions. We have a ton of activity on Facebook. So Nicole and I will be coming through that Facebook feed a little bit later today to go through and answer some of those questions. Some of them are email follow-ups. And so as always, if there's anything that we can do to help you guys out, always feel free to reach out to us. We're here every Thursday at 10 o'clock to give you your weekly update. And we certainly hope that if we're able to help you better advise your buyers and sellers, that in turn we'll get to see them at First American's closing tables and with One Trust. And so please reach out to us for all of your lending and title needs, and we'd love to work with you. Other than that, we hope you have a great holiday, or not a holiday weekend. Just have a great weekend.
A great weekend. One of the only non-holiday weekends.
Yes, I know. We're getting into the holidays. So thanks, guys. Have a great one. We'll see you next week.